Welcome to Grow Money Business, the podcast dedicated to helping business owners grow both their wealth and business on their own terms. Here's your host, Grant Bledsoe.
Hello, everybody. Grant Bledsoe here. Welcome back to Grow Money Business. This week on the podcast, we're talking about options contracts. Options contracts are, I think, an underutilized tool that can provide portfolio insurance for people who are interested in using them. They should not be used haphazardly. And if you're not really sure what you're doing with regard to options, I would highly suggest that you do not engage in trading this kind of instrument, or maybe you get a professional to help you do so, because you can get yourself into trouble with them if you don't know what you're doing. That being said, they can also be a really helpful way to provide portfolio insurance against the value of the securities in your account falling. And given that we're entering an age of a lot of economic uncertainty, I think a lot of people around the country are generally concerned about the values of their investments falling. I thought this might be an interesting topic to cover because there are probably some people out there in the world who might be able to use this strategy for their benefit. So in this episode of the podcast, I cover buying put options and selling call options in a whole lot of detail and how you might do so to provide portfolio insurance for yourselves, and I hope you enjoy it.
Hey everyone, I need to interject quickly to remind you all that nothing found in today's episode or any other episode of Grow Money Business should be considered financial, investing, legal, tax, fitness, or even relationship advice. It's content that you're free to use and to deploy on your own terms. And before taking any actions on content found on the show, please do consult with your tax professional, your attorney, or your financial planner. If you don't have a financial planner, head on over to threeoakswealth.com to learn more about what we do in terms of financial planning and investments and how we help clients on an ongoing basis.
So this week on the podcast, I want to talk about a strategy that you might be able to use to reduce risk in your portfolio. This strategy is not right for everyone, but for a lot of people who are savvy investors or maybe have a professional doing it for them, or are just generally comfortable when it comes to trading their own accounts, this may be a good fit. And the background here is we're entering a period of a lot of uncertainty regarding the economy and the markets. We've had a really bloody first half of the year, worst first half of the year that we've had in a long time, and one that ranks among the worst historically if you look back 100 to 150 years. The first 6 months of this year in the stock market was just about as bad as it's ever been, with the S&P down about 20%. And so a lot of investors out there are concerned about this, rightly so. They're concerned about the inflation numbers. They're concerned about geopolitical risk. They're concerned about the possibility of interest rates going up to tame inflation. And what the impact on the investment markets and their portfolios, their accounts, their finances, their livelihood might be. And there's an instrument or product, is another way of putting it, out there that I think is underutilized and can provide insurance against losses in your portfolio if you are so inclined to use them. Typically, in our financial planning firm, we don't really like to use them because they're not free, right? They do cost money, and I'll of course get into the specifics and explain what I'm talking about here shortly. But if you use them all the time, they can be costly and they can be a drag on performance. So our general philosophy at the firm is not to engage in this kind of instrument except in real specific, unique circumstances for people who feel like they just absolutely need to have a little bit of downside insurance against the market crashing and are comfortable paying a little bit of cash for that insurance. And the instrument that I'm talking about is an option. An option is something that's been used in the financial markets for a really long time. And essentially all it is a contract. It doesn't have any real substance to it other than the fact that it's a contract that gives you the right to buy or sell a certain security at a certain price for a certain period of time. Typically, These are used, the options are written against individual securities. If you own shares of, Ford or Nike or something like that, you can buy options that give you the right to buy at a certain price for a certain period of time, and they give you the right to sell alternatively in a different kind of contract called a put at a certain price for a certain period of time. And that can be kind of helpful if you're someone who has a whole bunch of shares of Ford in your account. Maybe you used to work at Ford. Now you have a whole ton of employee stock purchase plan shares, maybe restricted stock units that you've accumulated over time. The value of those shares has gone up over your career, and now you have this big unrealized gain. Maybe you're in a situation where you don't want to sell those shares of Ford, but you're concerned about the concentration risk. Well, one thing you can do is buy one of these contracts and give yourself some insurance in case the value of Ford falls dramatically, which would really have a big impact on your financial situation. So, like I say, these contracts have been around for a long time. There is a robust market for them in the United States. Traditionally, they were written on individual securities. They don't write options on mutual funds, but there are options on publicly traded securities like ETFs. So, what I wanted to talk about today are a couple strategies you might consider using if you're really uh, uh, overly uncomfortable about the possibility of the markets crashing and what that might do to your finances. We'll talk about some strategies that might make sense as a way to add some downside protection. So the most direct way to do this is to purchase what's called a put option. Like any publicly traded security, you can buy these contracts and you can sell these contracts short. And so if you're someone who's going to sell an option, you're giving the right to somebody else in the world to either buy or sell a certain security for a certain price for a certain period of time. But if you're buying them, you're paying money for the right to engage pursuant to the terms of the contract. Options have cycles to them. So they have expirations each month, and I used to deal with this stuff intimately. I can't remember exactly when the options expiration is each month, but it's like the second or third Thursday of each month or something like that. And so if you're going to buy a put option on shares of Ford, you might buy them for a certain price for the October expiration. And what that means is that if you shell out the cash to buy one of these contracts, you have the right to sell shares of Ford for a certain price anytime between the time that you buy the contract and the time that it expires in, hypothetically, October. Well, that's not an infinite window, right? So if the price of Ford shares stays steady or increases between now and when the options contracts expire in October, then you'd have paid money out of pocket for the right to sell without being able to exercise the contract. You would have gotten no benefit from it other than maybe being able to sleep a little bit better at night between the time that you buy it and October. You can also buy a contract for a longer period of time, right? Remember, these contracts, this market is set up in monthly intervals. So you can buy one for August, you could buy one for September, you could buy one for October, you could buy one for next April. I believe they go out as far as a couple years at this point through LEAPS. There's an acronym there, but it's basically a longer term options contract. And not coincidentally, the longer that you go out as far as the expiration date of one of these things, the more that contract is going to cost you, right? If you buy a 1 month option, so I'm sitting here in July recording this, if you buy an option to sell Ford at $20 a share, that will expire in in August, that's not going to be very costly because your window of opportunity to exercise this and actually use it is pretty short. If you buy a contract that doesn't expire until October, that'll be a little more expensive. If you push that out and buy one that's not going to expire until April, that'll be a little more expensive than that. Another factor in the cost or the value of these contracts is the volatility of the underlying security. And there's a number of factors. I'm not going to go through each and every one, but if you're buying an options contract on a stock that is really volatile and goes up and down every trading day by a wide margin, well, it's more likely that an options contract is going to become valuable between the time when you buy it and its expiration. So more volatility is going to make that contract more costly. Okay, so here's the simple example of when this might make sense for you. If you have a single security, and we're running with the example of Ford for now, and I don't have any idea where Ford is trading, which maybe I should look that up real quick. Ford appears to be trading today at $11.50 a share. So let's run with this example. Let's say that you're an you've just retired and you worked as an executive at Ford for 20 years. And you have, let's say, 100,000 shares of Ford accumulated through restricted stock units and shares you purchased as an employee that you got a little bit of a discount now, a discount on. And so you have 100,000 shares of Ford. If you multiply that by $11.51 a piece, that position is worth $1.15 million. So if you went and reduced this concentration risk, right? If you're concerned that the value of those shares is going to fall by a lot and it's going to put a big dent in your financial situation, well, why don't you go sell them? Well, maybe you don't want to do that because that could incur realized capital gains, which you need to pay taxes on. And if you're someone who's spent a whole career at Ford and you've been accumulating shares for a long time, chances are you probably have a lot of unrealized gains that you don't really want to trigger. So enter the put option. What you could do is shell out cash in your brokerage account and buy puts on Ford. One way to do it would be to buy an out of the money put option for maybe a few months at a time. Let's just say that we go all the way out until December. It gives you about 6 months to 6 months of security or insurance on your position of Ford. Well, you would buy enough put options to cover the 100,000 shares that you have. And the way that these contracts work is each contract that you purchase covers 100 shares of the underlying security. So that would mean that you would buy 1,000 put contracts. Maybe they give you the right to sell shares of Ford at $10 a piece anytime between now and when options expire in December. So if the value of Ford goes up from $11.50 to $12.50, well, guess what? You have just made a little bit on your Ford position. That's great, right? $1 a share multiplied by 100,000 means that your position has grown by $100,000. Well, if it falls by $1 from $11.50 to $10.50, you just lost $100,000 on your position, but it hasn't fallen by enough to where your options are going to be exercisable. You could still sell the 100,000 shares you have in the open market for $10.50. So why would you ever want to exercise this put option that you have and sell them for $10 even? Now, if the shares get cut in half and they fall to $5 or $6 a share, now that those put options that you own are in the money. And whereas they're trading in the market at $6 a share, hypothetically, that's when you can exercise this put option and sell them for $10 a share that's specified in the contract. So it's a really nice way to mitigate your risk. Now, the downside there is if you have a large unrealized gain that you're trying to avoid, well, in order for the value of your put options in this scenario would go up and up and up. The value of your Ford holdings go down, down, down. And it should be set up in a way to where those two things offset each other. And so if you're in that situation, you have a choice. You could exercise the option and sell shares of Ford or put them to the seller of the contract at $10 a share, but you'd have to realize the capital gain that you were trying to avoid in the first place. The alternative is you could sell the put options, because if you buy them, and I'll look up the price of these options here in just a minute to give us some perspective. But you could also sell the contracts themselves in the options market. You'd have a gain on your hand because the value of those options are now a lot higher than they were when you bought them, because the price of Ford has fallen, and you incur a taxable capital gain on the contracts themselves. So you're creating a taxable event, but it's a nice way to provide some insurance against potential loss in the value of a position. Now I'm going to look these up really quickly. I have Ford up on my screen. I'm going to go out until December. Ford December $10 puts are trading at 82 cents a share. Okay. So to give yourself the right to sell Ford at $10 a share anytime between now and December, it's going to cost you 82 cents per share for that insurance. And so what that means is that if the price falls to $6 a share, you have that contract is in the money by $4. It's trading at $6 a share. You can sell it for 10. And so the net benefit to you is that $4 difference less the 82 cents a share that you paid for it. Excuse me. So that's a nice way to build some insurance into your portfolio, right? The downside of this obviously is that it costs money. And if the shares of Ford fall from $11.50 to $9.50, you still probably want to exercise them and capture that difference. But the price hasn't fallen below the strike price. The strike price is what you can exercise the contract at by enough to offset the cost of the contracts in the first place. So you're still providing some kind of insurance, but you haven't covered your costs from the endeavor in the first place in that circumstance. So that's one way. We can buy put options and provide some kind of floor to the value of the securities in your accounts. And if you're someone who invests in low cost diversified ETFs and mutual funds, we can buy put options on most of these securities. As I mentioned, ETFs are traded in the secondary market. When you go to buy one, you're buying it from somebody else out there in the market. You're not exchanging directly with the issuer as you are in a mutual fund. And most ETFs that have a fair amount of liquidity have options markets, options contracts written on them. So unless it's some obscure, thinly traded ETF, or maybe a new ETF to the market, and there are a ton of new ETFs that are coming to the market every month, you can probably find an options contract on it. If it's a mutual fund, you can't. There are not options traded on mutual funds. And so what you might want to do in that circumstance is find an equivalent ETF that holds relatively similar securities. For example, if you have an S&P 500 index mutual fund, it's pretty easy to buy a put option that would be a pretty good proxy for that holding. You just buy a put option on an ETF that tracks the S&P 500. It's very similar, and if the value of the mutual fund falls, the value of the ETF is going to fall, and therefore your put option becomes valuable to you. SPY is the biggest S&P 500 ETF out there. That's probably a good place to start. That being said, if you have a more obscure mutual fund, then it's going to be harder to find a proxy through an ETF for it. So in that circumstance, you need to get a little bit more exotic with it, and you have a higher likelihood that the value of your option or the insurance on your portfolio that you're looking at is going to behave differently than the actual holding that you have in the account. And that's a problem, right? You want those two things to be equivalent. That's why you're looking at this in the first place as insurance against the value of your portfolio holdings going down. So that's that's the first way to do this, and really the most direct way. If you're concerned about things going south in general, you're concerned about the value of your holdings plummeting, you can buy insurance against it through an options contract. But as we mentioned, it can be an expensive endeavor. So remember Ford, you're not even covering yourself dollar for dollar. If the value goes from $11.50 a share where it is now to $10.50, you've lost $100,000 and your options contracts aren't even valuable yet. Those contracts themselves are good for about 6 months from middle of July when I'm recording this to middle to the end of December. I think it's the third Tuesday or third Thursday of the month is when the expiration is. So you have 5 to 6 months of window for this to take place, and it's going to cost you 82 cents a share or $82,000 for that right in the first place. So it's not inexpensive by any means, but it can provide a lot of protection. Now, the example, remember that these things are priced partially based on the volatility of the underlying security. And an individual stock is usually going to cost you more than an option on a broad diversified ETF. So let's take a look at SPY. I'll bring that up here too. So SPY is, again, the ETF that tracks the S&P 500. It's the biggest ETF that tracks the S&P 500. Last price here was $378.85. Look up the options. Now, we're not going to buy a put that gives us the right to sell it for $10 like we would Ford, because that's so far below the current price that it's not going to be beneficial at all. Now, we've got puts. Let's go to December puts on SPY. At the money put, so the SPY is currently trading at $378. If we bought an at the money put, which means that the strike price equals is the same as the current market price. So in other words, a put contract that gives us the right to sell SPY at $378 anytime between now and the end of December, that's going to cost us $23.85 a share. That is a very expensive endeavor, in my opinion, because the value of that security would have to fall by more than $23.85 for us to come out ahead in the first place. And that's, maybe an 7 or 8% drop over the next 6 months of the year. And maybe you're someone who thinks that's going to happen, or maybe you're someone who's comfortable paying that much cash out in exchange for this insurance. The problem that I see with a strategy like this, and it kind of goes back to our philosophy I mentioned at the beginning of why we don't generally do this in client accounts, is you have limited window. We're talking about paying 7 or 8% of a security's value to give us this insurance. And the insurance is only good for about 5 months, 5 or 6 months, between 5 and 6 months. Then you have to shell out the cash again after the options expire for the next 6 months and do it over and over and over again. So it's an easy way to rack up a whole lot of cash needs or expenses, because often these things are sold and then they expire worthless, and it's just a tough situation. Now, in general, in the financial markets, this is related to the cost of these contracts. The more obscure the security or the instrument you're looking at, the bigger the bid-ask spreads, the more expensive they are to you and me as buyers, and the more profitable they are to Wall Street banks, broker-dealers, market makers, people who are engaging in these transactions on the institutional side every day. And options market makers, who are the parties that you and I would be buying options contracts from and selling them to, make a lot of money. The bid-ask spreads in the options market are huge because they're kind of an opaque instrument. They have all sorts of contracts for all strike prices and expiration dates across a whole ton of securities. It's an opaque market and it's expensive to get into. So that's the caution here. Don't engage in this unless you know what you're doing, you're comfortable shelling out the cash to buy this insurance, or you have a professional doing it for you. Because you can really get yourself into trouble if you buy or sell the wrong thing inadvertently, and it's a little bit confusing looking at all of these contracts all at once if you've not seen them before. Now, the other way to reduce risk, we've been talking about put contracts. You buy a put that gives you the right to sell a certain security at a certain price for a certain period of time before that contract expires and goes away. A call is the exact opposite of that. You can also buy a call that gives you the right to buy an underlying security at a certain price for a certain period of time. And a lot of active traders will like to use call options. You could buy, back to our Ford example, it's currently trading at $11.50. So if you bought a $10 call that gives you the right to buy it for $10, well, that's immediate. That's in the money right now because the current market price of $11.50 is greater than what you could buy it through the call option for. So the value of that contract is going to be pretty high. It's going to be that $11 or that $1.50 difference plus the volatility plus the time remaining before the expiration of the contract. If you're someone who's really bullish on some security, you think it's about to pop for whatever reason, or maybe you think the market's about to pop, going back to SPY. SPY is trading at $378. Maybe you think we're going to hit some huge rebound here over the rest of the year. Well, you could buy an out-of-the-money call, which gives you the right to buy it for $400. And in that circumstance, it's not going to cost you very much to buy that contract, but it's going to give you the right to buy it for $400, even if the price of SPY goes up to $450 between now and the rest of the year, and the end of the year. So there are all sorts of complex trading strategies that people will sometimes use regarding a mixture of calls and puts. You can do straddles, you can do spreads. A straddle being you buy a call and a put, and as long as the volatility of the underlying security goes up, you're probably going to be in the money on one of those contracts, right? If you have a very steadily valued stock that hasn't deviated from $50 a share for 10 years, well, it might not be too expensive to buy a call and buy a put. And you might not know the direction that the stock's going to go in, but you think it's going to go somewhere for whatever reason. Well, you buy both of them. If the volatility does go up and the price goes up or down by 10%, then immediately one of those contracts is in the money and valuable to you, and you can exercise them and close the position, and you've just made a little bit of cash. That's getting toward the more complex side of things that we really try to steer people away from, because you can easily get yourself in trouble. You can take a lot of risk unknowingly in this kind of thing, and one mistake can negate a lot of years and years and years worth of returns and profits that you may already have realized. So again, I tell this tale with caution. Don't jump into this stuff haphazardly. Now back to calls and why we can use this as a risk mitigation technique. If we buy puts That's basically insurance against the value of your securities falling. We can sell contracts too. We can sell puts, we can sell calls. And one strategy a lot of people will engage in to produce income in their accounts is through what's called a covered call. If you have 100 shares of Ford in your account, it's trading at $11.50 a share. Well, you can sell out of the money calls. And what that means is you're selling to somebody else the right to buy shares of Ford from you at a certain price for a certain period of time. So one example of that might be selling $15 calls that expire in December of this year. If you sell a call, somebody else out there in the world has the right to buy shares of Ford from you for $15. And so if the shares of Ford that you have in your account, the 100 shares don't go anywhere over the next 6 months, they're worth the exact same amount 6 months from now as they were today. Well, that $15 call would not be exercised. It would expire worthless. You might collect dividends over the next 6 months from holding the stock, and you collect the cash by selling that contract in the first place. So when you sell a call, you have cash, the value of what you sold it for, deposited into your account, and you have the obligation to sell it to the specified price if it's ever called away or exercised. So if you're selling out of the money calls, you're generating some income and some cash. If the value of Ford falls to $6 a share over the next 6 months, you wear that because you don't have any instrument to sell it for more than the market price at all. But it's considered a risk mitigation standpoint because you did sell an option and generated a little bit of cash income that does improve your returns by a little bit. The downside, so that's the benefit of it, right? The benefit of selling a call and doing this covered call strategy is you're generating cash and income into your account that you would not otherwise have had. The downside and the risk to it is, what if Ford pops and it goes to $25 a share? Well, the shares that you have sold a call against are definitely going to be called away in that circumstance. And even though the market price of Ford might be $25 a share, you're obligated through this contract that you sold that I can guarantee you your broker is going to enforce. You're obligated to sell the shares for $15 and you would have lost out on $10 a share of profit. So you're putting a ceiling on your returns when you sell a call option in exchange for additional income in the meantime. So it's not as direct an insurance policy against the value of your securities going down as a purchase of a put option is. But it's something that a lot of people engage in. There are a lot of mutual funds, particularly closed-end mutual funds out there in the world that pursue covered call strategies to generate income, and that can work for a lot of people. In general, again, I'm not a huge fan of this unless it's for a real specific, unique purpose. Because, excuse me, because the equity risk that we take on an ordinary basis is a better way to generate consistent long-term returns. The more exotic that we get using these other instruments on top of that, the more likely we are to shoot ourselves in the foot and forego the equity returns that we get in exchange for taking the risk of being invested in stocks and bonds in the first place. And so it's a good way to negate and basically cancel out a lot of profits that you may have earned over the last decade that you're entitled to for taking that equity risk in the first place. This is a way to put a ceiling on your profits, and is another way of putting it. So the two main ways to do this, just to recap here, you buy puts or you sell calls. You can also, the third way to do this is to combine the two, and you can sell calls against the positions that you have in your account generate some cash for that. You're limiting your upside based on the strike price of the contract, and then simultaneously go buy a put. And the reason that some people will do that is if you shell out the cash to buy the puts, just like we were looking at with Ford, that can be really expensive if you renew that insurance every so often when the contracts expire. And so one way to reduce the cost as well, you sell a call against the same position to generate some cash. You're putting a ceiling on your potential returns because if the value of the Ford shares goes beyond the strike price, you're not going to get the benefit above the strike price. You'll have the shares called away. But it's a way to reduce the cost of that insurance in the first place. So option one is you buy the puts. It's the most direct way to mitigate your risk. Option two is you sell calls, which limits your upside. It does not take away any of the downside risk, but it generates a little bit of income. Option three is you combine the two and you put a ceiling on your returns and limit the amount of downside risk depending on the structure of your contracts. Now, if you have a brokerage account out at some place, generally brokerages are not going to allow you to just willy-nilly go in and trade all these exotic things on day one. They're going to have some kind of approval process to confirm that you're experienced enough to not get yourself into trouble. And there are several levels of options approval. Back when I was at Schwab, I think there were 3 levels of options approval, and you had to provide some insight into your investment experience and your experience with options and your objectives for the account and your net worth and so on and so forth. And if you were not an experienced person or didn't have the liquid net worth to support your options activity, they would just flat not allow you to do certain things. So if you have all the approvals, then you can sell whatever options you want with impunity. But if you have only the lower levels of approval, then any calls you sell will have to be covered, meaning you have to own the positions in your account before selling a call against them. Maybe you can't buy puts until you have those covered too. And, there are all sorts of shapes and sizes of approval. Excuse me. So, at any rate, this is something that might be a fit for some of you out there that are really concerned about downside risk. You want ways to mitigate that risk in general. Tread lightly with this. It can be costly, and you can get yourself into trouble. I'll give you an example of how you can get yourself into trouble. You can sell calls against positions that you don't own. So what we were talking about are covered calls. You own 100 shares of Ford, you sell a call against those shares, meaning that if the price goes from $11.50 to $25, you're going to sell the shares in your account at whatever the strike price was if it's exercised before the contract expires. If you have all these levels of options approval that I'm butchering my description of, you can also sell calls against positions that you don't own. That's the opposite of a covered call, is a naked call. You don't have shares of Ford. Let's say that you sell that $15 December call out there to someone in the universe, and the price doesn't go up to $25. The price goes up to $100 because maybe they're going to get acquired and there's all these great opportunities. Maybe revenues go way up. Whatever the story is, your risk is unlimited because you're obligated to sell it for hypothetically $15 a share when it's worth whatever, $25, $50, $100 a share. So since you're obligated to sell it and you don't have it in your account, guess what? You now have a short position of negative 100 shares of Ford. In this example, you would have borrowed that 100 shares from your broker and you'd be obligated to pay them back at some point in the future. And so you can force yourself into a short position of the underlying securities when you mess around with options. That can be okay for some people. For most people, it is probably not appropriate. And this is the exact side of the market that I was intimately engaged in when I worked at Schwab. You have to be able to continue borrowing the shares to maintain the position. Your broker can buy you in at any point for any reason, really. They can close the position out, and you would have lost the difference if the shares of Ford went all the way up to $100. You would have lost the difference between your strike price, $15 on $100 a share, $85 multiplied by 100, just goes out the window. So these are cautionary tales. Tread lightly with this stuff. If you're really interested in some kind of insurance on your portfolio in this manner, and you're not really sure where to start, this is a good reason to find an advisor out there that knows their way around these instruments. Because you can get yourself into trouble if you do it haphazardly or don't know what you're doing. Okay, that's it for today. I hope this was helpful, not too technical. I butchered a couple of my explanations and descriptions, but this is something that I think is underutilized by a lot of people, particularly when you have a lot of a single security by virtue of working at a publicly traded company for a long time. Put options, calls against the option, they're just a helpful way to mitigate concentration risk for a closely held position. Okay, that's it for now. Hope you all have a good week, and I'll talk to you again soon.
Thanks for tuning in to Grow Money Business, the podcast dedicated to helping business owners grow both their wealth and business on their own terms. Be sure to subscribe to the podcast on iTunes, Google Play, or wherever you digest podcasts to ensure you don't miss out on future episodes and announcements. And feel free to submit questions to growmoneybusiness.com.